Greetings. Today is Friday, March 1st, 2024. This is our monthly market monologue, and I'm a little under the weather, so I'm going to try to keep it brief today. But before we dive in, a couple of housekeeping items. All tax forms should be posted to the Charles Schwab Alliance website. If you have any problems accessing your forms, please let my staff know. But all forms should now finally be posted on the Schwab Alliance platform. The other thing is we want to make sure that we're reminding you, if you have not logged into the Schwab Alliance website recently, you should make sure that you do so before March 27th, because otherwise Schwab is going to convert you back to paper statements. So go ahead and log on, get your tax statements, and make sure that you are signed up for electronic delivery of all statements, confirms, etc., etc. So that said, let's dive in. The first thing that we're going to look at today is the value line geometric index, and that is on the screen right now. The value line is approximately 1,700 stocks. It is calculated with a geometric average, and it is equally weighted. So this is another way for us to look at how broad the market is. What we want to show you is the fact that for some time now, this index of stocks has not been able to break through this level. I would argue that what we're seeing on the right-hand side is good news. It's meandering higher, and I think the chances of this breaking out above that level is actually very good. If it does, that is very good news for the broad market. Next thing we want to look at is year to date, and of course year to date is only 2 months, but I'm doing this on purpose here. I've got 4 ETFs on the screen. We've got the mega cap ETF, that's, you could argue, is the Magnificent Seven. Then you've got the S&P 500. Then we have mid cap and small cap. And you can see there's still a bit of a divergence here. Mega cap's still leading the way. I won't go into it today, but some of those stocks in that mega cap or some of the stocks in the Magnificent Seven are definitely breaking down. Tesla in particular is really struggling this year. But let's flip and say, instead of year to date, let's look at just the month of February. Now here we have those same ETFs, but we're zeroing in on just the month of February, and you can see there's a much tighter grouping between the mega caps and the rest of these ETFs. So again, good news, it's not just the mega caps or the Magnificent Seven that are participating. We're starting to see some really good participation in the small and the mid cap space. So that said, let's zero in on small caps. Now we have small cap ETF on the screen. This is the iShares Russell 2000. We've talked about this many times. This right now is a weekly chart, and what I'm trying to demonstrate here is that we've been in this 2-year range. We broke out early this year. We fell back in, but look what's happened. Again, we're breaking out. That is good news. We will look at it again this way. Now I've got a daily chart on the screen, but again, I'm showing you the same thing. This is this 2-year sideways consolidation. We broke out in early this year, but we fell back and we fell down to this 50-day moving average. But look at that. The 50-day moving average kind of served as support. And when you have a stock or an ETF that breaks out of a trading range, it's very, very common for it to come back and kind of retest it. In this case, it retested the 50-day. The 50-day served as good support, and it has come back and again closed the month outside or above this trading range. So that's very good news. In addition, when we look underneath the surface, what's the percentage of these stocks that are trading above the 200-day moving average? In other words, in this small cap sector ETF, how many of these are in long-term uptrends? And right now you can see we're still well above the 50% range. So more than half of the stocks in this index are in a long-term uptrend. And so what I see here is actually good news. It's consolidated, but I like what I see here on this screen. A couple more slides for today. This is our seasonality chart. This is again showing you the S&P 500's performance on average since 1950. Again, the problem with this, of course, is it's still cap weighted, but in general, I just want to highlight the fact that the month of February was pretty good for the S&P 500. We like how we performed in the month of February, and matter of fact, year to date, we really liking what we're seeing. And then 2 more charts for you, and then we'll land the plane for the day. Inflation, again, we've talked about this a lot, but inflation continues to come in However, it's not going away. And as we've talked recently, inflation, yes, it's come down, but we haven't seen deflation. So the prices of your groceries, et cetera, they're still high, but they're not continuing to grow. So the inflation is the year-over-year change. That has come back down. We're well within striking distance of the 10-year average. Still a little elevated based upon where the Fed would like it to be, but this is much, much better than where we were. However, one of the things that you would see if you watched the economic update video that I posted, I believe last week, one of the things that we've talked about is the fact that there is a very real risk that inflation will come back. And earlier, I think yesterday, as a matter of fact, we sent out an email to all of our clients and some of our other friends that talked about or highlighted the fact that JP Morgan recently issued a statement that said that they believe that the United States is at risk of entering a 1970s style stagflationary environment. Well, we've been saying that for several years now, and I'm not predicting that it's going to happen, but I'm saying I see the conditions are appropriate. The conditions are ripe for that type of environment to exist. On the screen right now is 1965 through 1979. If you've been watching my channel for any length of time, you know I've shown this a lot, because this is not hypothetical. This actually happened in the United States. And if this time period, this is 15 years, and you can see that it was a very violent time period in terms of the stock market. Yes, there were some periods of bull markets, but there was also some very ugly bear markets. That duration, that long time period, that 15-year time period, that is a secular bear, but there's definitely periods within this that were cyclical bulls. And the point is, if we return to a period like this, we have to be prepared. I'm not predicting that we're going to be in an environment like this. I'm just saying that the conditions are ripe for a return to something like this, and it's possible that we're already in this secular bear market. And so the reason we invest the way that we invest, the reason we trade the way that we trade, is because we're not guaranteed to be higher. The stock market is not guaranteed to be higher a year from now, 2 years from now, 3 years. It is not guaranteed. So we prefer to take gains when we have them, and we want to cut our losses short. So if you have any questions on that, by all means, let us know. Happy to chat in more detail. If you have any questions, again, reach out to us. We serve clients here in Cary, North Carolina, but really all across the country with today's digital age. So if you want a second opinion on your portfolio and how it's being managed, by all means, feel free to reach out. And until next time, thanks for watching. We'll talk to you soon.